So far we have talked about corporate valuation using the discounted free cash flow approach. There is an alternative valuation approach, which is to use multiples, and this is also a very frequently used valuation approach. Relative valuation methods do not provide a direct estimate of a company's fundamental value like the free cash flow model does. Instead, they indicate only whether it is fairly priced relative to some benchmark or peer group. Relative valuation methods rely on the use of multiples. A multiple is a ratio between two financial variables. In most cases, the numerator of the multiple is either the company's market price or its enterprise value. The denominator of the multiple is an accounting metric such as the company's earnings, sales, or book value. The enterprise value is typically defined as the market value of its capital, which includes both debt and equity, net of cash. So the frequently used price multiples include the price to earning ratios, including the PE ratio, the P over EBIT ratio, and P over EBITDA ratio. And then there's price to sales ratio and price to book value ratio. And the commonly used enterprise value multiples include the enterprise value over EBITDA multiple and the enterprise value over sales multiple. The most popular price multiples are earning multiples. So the most widely used earning multiple is the PE ratio, or say the price to earnings ratio. However, because the earnings, or say the net income, are influenced to varying degrees by how the company is financed and where it pays income taxes, some analysts use price to EBIT ratio to remove the effect of the company's capital structure and income taxes on its earnings. Some other analysts, worried about the distortive effect on earnings of accounting policies with respect to the depreciation of tangible assets and the amortization of the intangible assets, they prefer to use the price to EBITDA ratio. The price over EBITDA ratio is also popular because of the close relationship between a company's EBITDA and its cash flow from operations. The P over EBIT and P over EBITDA ratios all require positive accounting earnings. But not all companies are profitable, particularly the young companies. So for companies that are operating at a loss, analysts may use alternative multiples such as the price to sales ratio. Another price multiple is the price to book ratio, or say the PB ratio. It indicates how much investors are willing to pay over book value of their equity investment in a company. Unfortunately, a company's book value is highly sensitive to accounting standards and management's accounting decisions. Therefore, the PB ratio is neither a valid nor valuable valuation method for most companies, except perhaps for financial institutions and insurance companies. Some analysts prefer to base their valuation on the price to cash flow ratio because cash flows are less sensitive than earnings to accounting choices and potential accounting manipulations. This approach is also consistent with the viewpoint that value is primarily driven by cash flows. So let's take a look at the example of using PE ratios for terminal value. We use the following example to calculate the terminal value using first the earning forecast and second the terminal price multiple based on comparables. We'll calculate the terminal value in 3 years. For the firm that we want to value, the required rate of return is 11%, and the EPS, earnings per share, forecast for year 3 is $2.50. And we draw some ratios from the peer group. So from the peer group, we see the mean dividend payout ratio is 0.4, or say 40%, and the mean ROE ratio is 8%, and the median PE ratio is 9. So as you see, for the company that we want to value, we try to get a peer group and try to find the average, mean or median value of some major ratios from the peer group. To use the PE for the terminal value at the end of year 3 is the PE ratio multiplied by the EPS at the end of year 3. So it's simply 9 multiplied by 250, and it turns out to be $22.50. Notice here the result is for the value of the stock per share. If the company has 1 million shares outstanding, then the total value of the equity is 22.5 million. As you see, the calculation is very simple and very straightforward. So now to summarize this whole lecture, this lesson focuses on using free cash flow forecast to estimate the value of a corporation. And from the last video, we learned that the value of a corporation comes from two parts: value of operations and the value of its non-operating assets. Corporate value can be divided by claims by the debt holders, preferred stockholders, and common stockholders. So among them, debt holders have the first claim, preferred stockholders have the next claim, and any remaining value, or say the residual value, belong to the shareholders. So to estimate stock price, the price per share equals to the value of operation plus the value of non-operating asset, and then subtract the value of debt and the value of the preferred stock, and the result is divided by the number of shares outstanding. Fundamental or intrinsic value of operations can be estimated as the total present value of all future expected free cash flows. We started with a constant growth model, and we extended to a two-stage non-constant growth model. Under both models, we calculated the total present value of all future expected free cash flows discounted by the WACC, weighted average cost of capital. We also learned that price multiples are useful tools frequently used in valuation, and they are called the relative valuation methods. The next few slides talk about the guideline for the case analysis report you are supposed to complete. As usual, they will not be covered in the video. However, I strongly recommend you to read the guideline before you start your case analysis. And again, if you have any questions about the case analysis assignment, please feel free to contact me, and I'll be very glad to talk to you about this lecture and the assignment.